What if I told you your child could be a millionaire by the time they hit 50 and never pay a dime on any of it? Look, this isn't clickbait, it's simple math, and it's completely legal. It's called the Roth IRA for kids, and most parents have no idea that they can do it. So today, I'm going to show you how exactly parents can legally fund a child's Roth IRA, how to invest it, and how to grow it tax-free for decades. At the end, I'll even show a few infinity investing strategies I use for my own clients and my own family. Make sure to hit the like and subscribe button in the meantime. It really helps us on the algorithm. By the way, I'm Toby Mathis from Anderson Business Advisors and Infinity Investing. I teach investors how to build wealth the smart way through legal and tax-efficient strategies to help them keep more money in their pocket and out of Uncle Sam's. I'm also a tax attorney, been doing this for about 30 years. And one of the simplest ways to set your kids up for life without gifting them money or paying gift taxes is by getting them started in a Roth IRA. A Roth IRA is a retirement account where you contribute after-tax dollars and the money grows completely tax-free. There's no tax on the growth and no tax when they take it out at retirement. But this is where it gets fun. If your child starts young, say around 12, and consistently invests, even just for a few years, that money has decades to grow through compound interest. Let's run the numbers. If your child earns $5,000 a year from age, let's say 12 through 18, that's 7 years, and contributes all of it to a Roth IRA, they'll have put in a total of $35,000. Now let's assume they simply let it grow in a basic S&P index fund, SPY-VOO, right? It's about 10% a year, historical average. By the age of 60, that account would be worth roughly $2 million, tax-free. That's the magic of compounding, right? That's letting it just cook. It's letting the cake bake. And the reason why starting early is so powerful. To open and contribute to a Roth IRA, your child just needs earned income. And that means actual work, like wages, self-employment. It's not allowance or gifts. It's if your child works and if they work in your business. So maybe they're helping you with social media. They're cleaning out rentals for you if you're a landlord. They're packaging products. Maybe they're appearing in photos or videos. That is all legitimate earned income. The pay just has to be reasonable for the work that you're doing. So again, if you're paying your 12-year-old, let's say $5,000 a year to genuinely help with content, marketing, or office support, that is totally fine. Paying your toddler $3,000 a year or $30,000 a year as a consultant, the IRS won't buy that. It just has to be something that they actually do that's legitimate. And this is where business owners win big. You can hire your own kids. You can pay them a fair wage. And that money is tax deductible to you. It's a business expense to you. And then your child can put that earned income into their Roth IRA. That's a double win. You get a tax deduction and your child gets a lifetime of tax-free growth. And more importantly, if the amount is below the standard deduction, your child is not paying taxes on it. At least federal income taxes are gone. Setting it up is easy. In fact, I'm going to walk you through this. Number one, all you're doing is setting up a Roth IRA. You're setting up a custodial Roth IRA. Your name stays on the account until your child turns 18. Some states it might be as high as 21, but you're opening it up at Fidelity, Schwab, Vanguard, all have great options. And you're making sure that we're going to talk about the investing in a second. What you want to do is make sure that your child has earned income. And this means if they're doing any sort of work and you're running them through W-2, you just have it documented. If you are paying them as an independent contractor, they're doing work for other people, 1099, right? But if it's a really young child, it's probably working for your business and you're running them through payroll, even if you don't have to do withholding and even if there's no taxes on it. You want it documented. Number three, keep good records. This is super powerful strategy, right? This is something where quite literally, because your child is below the standard deduction, they are not paying any tax on this money. And then if that money grows and becomes millions of dollars, they pay no tax on the growth. And if they take it out, they pay no tax when they take it out. This is super powerful, so make sure that you keep records on it, job description, timesheets, even photos of the work, anything. Once it's open, you and your child can now invest in that IRA, and that's where it gets really, really fun. For 2025, the Roth IRA limit, the amount that you could put in here is $7,000. It gets indexed for inflation. They raise it some years. In 2025, 2026, I think it's 7,000. It's the amount of their earned income or 7,000, whichever one is less. So if your child earns $5,000, they can contribute $5,000. Now here's the trick. You can gift them the cash to make the contribution. As long as they earned the money and they earned $5,000, you could take a gift of $5,000 and put it in their Roth. Think of it like a parent match. They earn it and you help fund the Roth. It's that simple. They've got decades of runway, so you want high growth, low cost investments. My infinity approach, I would do like an S&P 500 index fund or a total market ETF. Like SPY, VOO, VTI, all of these are great. Maybe a dividend growth stock or REIT fund once they understand the basics. The whole idea is to own these things long-term, not to trade, not to be someone who's doing short-term trades. What you do is you hold it. It's the time in the market, not timing the market in this case. Teach them that real investing means owning productive assets and letting time do the heavy lifting. Let's put this into perspective. You hire your 12-year-old to help, maybe they're in your business, they're doing marketing, maybe they're doing video edits. Gosh knows that all these kids are better at tech than us. Maybe they're doing product packaging. And you pay them $5,000 a year through the age of 18. So that's 7 years. You've paid them a total of $35,000. They invested in a simple index fund. They leave it alone, and by the age of 60, it's worth $2 million, completely tax-free. If they keep contributing to it as adults, even small amounts, it could easily exceed $3 million or more. And that is how generational wealth quietly begins. So here's the recap. Your child must have earned income. You have to open a custodial Roth IRA if they're under 18 or under 21, depending on the state. The money grows tax-free for life. You can hire your own kids. You can take a deduction. You can fund their future. And if your kids are below the standard deduction, it is tax-free. This isn't just about money. It's about teaching ownership, discipline, and financial independence. Folks, if you got value from this, please like and subscribe. It really helps our algorithms. And if you'd like help setting this up, talking about hiring your kids, entity structuring, tax help, all those things, join us at the Tax and Asset Protection Workshop. I'll put a link for it. It's absolutely free. We teach them on Saturdays. Until next time, keep investing wisely and keep more of what you earn.